Let's move to the next part. Yes, this is our today topic. This is our today topic, what the taxable income as per the Article 20 of the city law. There is a 8 adjustment in accounting profit. Under 8 adjustment, each adjustment there is a multiple adjustment. Okay, so we're gonna start that, but before starting this, I'll share one link for the quiz in the group. So please take 5 to 7 minutes and complete that. Thank you. Let's start today session again. Hope I'm audible and my screen is visible to everyone. Guys, I'm audible. Please confirm. Okay, let's start our next topic. Taxable adjustment. As of now, we understand why we gonna do this adjustment and where we gonna do this adjustment, and whether this tax, what are the importance in the while filing the corporate tax return. So what will be the importance of today's session? Here I mentioned the city degree law 47, but the corporate tax law, this is they announced the taxation in 2022 in May or somewhere. But as of now, after the corporate tax law, the many cabinet decision, ministerial decision, and the FTA decision, and the tax procedure law, and the FTA guideline is available. So what we have to go through while preparing ourselves for the taxation, we have to go through all the part, because maybe something in the city law they already mentioned, but in degree law, they give the amendment for the same. So from where we can get this? From where we can get this? So we can have, I share the link, the Ministry of Finance. So would you please open the Ministry of Finance link and see what are the things covered over there? Just for our understanding, I'm gonna open that and share with you guys. Okay, now you may be able to see the screen where I already opened the Ministry of Finance website. So here, if you open the Ministry of Finance, go to the tax policies and legislation. Then here you can go take the corporate tax also, VAT also, and here the tax legislation also will be available. So tax legislation, all the tax legislation is available over here. You may download from here all the cabinet decision, ministerial decision, and what are the amendment, and you can go through that. But for sure, wherever the relevant topic is coming, we will go through that relevant CD. CD is a cabinet decision, MD is a ministerial decision. We will go through that relevant part of that ministerial decision and cabinet decision also. But in case you want to have the self-learning, you can go and download all that and go through. So as of now, maybe more than 70 or 80 ministerial decision or cabinet decision is available. So note down what we will go through, or what is the main area that you will while reading, or while reading the taxation, what are the main area or main thing that you will spend on your learning. That is the corporate tax law that we already discussed. This is the one of the very old taxation law. After that, many amendment is there. Maybe something mentioned in the corporate tax law, but as of now, maybe in amendment they already changed. So you have to go with the corporate tax law, ministerial decision, cabinet decision, FTA decision, tax procedure law. This is the 4 item, plus the 5th item is the FTA guidelines. Again, the FTA guidelines or FTA clarification, they announce very many guidelines. Okay, so by this is not the law. There is many people are dispute on that. This is not law. So we should follow the law. That we agree on that. We agree on that because we follow the law only. But still, the who will administrative body for the taxation is the FTA. So FTA share the guideline considering what are their understanding in terms of the taxation, right? But you cannot 100% rely on that, but still you can take your understanding and go to the taxation, read on that. And if you have some ambiguity, you understand from the FTA guideline also, FTA clarification also. Because even in the document itself, they are mentioning this is not the law. Hope this point is clear. Now let's see the article taxable income as per the article 20 of the city law. In the city law, we can go and see the article number 20 and we will see what are the taxable income. And now we are going to see what are the adjustment in the taxable income. We have to make there is a 8 adjustment in the accounting profit. Once we make the 8 adjustment, then we are able to reach on our taxable income. What is the taxable income? That for tax purpose, we will apply the tax calculation on that. But from where we will start? We'll start from the accounting profit. Yes. Okay, now within in taxable income, there is a 8 adjustment that we will apply in accounting profit to reach to the taxable income. So from where we will start our calculation from the accounting profit before tax. This is the point from where we'll start. This is the second last item in the income statement. What is the last item? That is total comprehensive income that already we've seen in the previous slide also. Accounting profit before tax, this is our starting point. This is second last item. So once we take this figure, then we'll start making the adjustment. So as we already seen as per the article city law, there is a 8 accounting adjustment we have to apply, whatever the applicable. But the 8 means these are to learn that these are the area that where we will look into that while applying the adjustment or while calculating the taxable income. Maybe each business they not have all the item, and maybe they have it. Maybe they have 4 items. But if you are aware, then you can check one by one these items are available, so you can adjust that. If not available, so you will move on. Okay. So now here today our topic mostly will cover only the first adjustment, because under first adjustment there is another 12 adjustment. Because now we're going to discuss the first adjustment. We are seeing the first out of 8, that is add back disallowed expenses and non-deductible expenses. Our first adjustment we have to, what are the, because in accounting profit, we do the accounting profit calculation as per IFRS. Then from that, we have to calculate our taxable income. So maybe expenses as per the accounting is the expense, but the same expense will not be the expense under the taxation. We'll take the example for our understanding. The entertainment expense. Entertainment expense, if you spend on your employee, give any kind of entertainment to your employees, that will be 100% allowed expense. So you already deducted from the wage, your profit, accounting profit. There will be no adjustment in that regard. But if you spend the entertainment expense on your customers, vendors, other stakeholders, owners, partners, directors, that is the ownership or the connected person, other stakeholders, all the other stakeholders, then that 50% is allowed only. So which means in accounting, you already deduct the 100%. Now your accounting profit is reduced because you deduct the 100% of entertainment expense. Let's say your accounting profit is 1 million. Accounting profit is 1 million in which all the adjustment is already done. But now you have you want to make the adjustment for the 100,000 of the entertainment expense that you spend for your stakeholders or the partners or the customers, vendors. So here you already deduct the 100,000 from the 1 million. So after the deduction, you are reaching the accounting profit is 1 million. But now here is saying the 50% of that expense is disallowed. What you will do? You will take the 50% of 100,000 and now add back to the 1 million. So now your accounting profit will remain same, but the taxable profit will be 1,050,000. So this is the definition of the add back. This is the understanding to disallowed expenses or non-deductible expenses, how it will impact. Hope this point is clear. This. So here we already mentioned, just for understanding, already minus from the accounting, but tax authority is saying disallowed. So we will add back, and now our taxable profit will be increased because some expenses will minus. Now we are adding back, so our taxable profit is getting increased. Let's move to the next point. Now here the allowed expenses. As per Article 28, there is a list of allowed expenses. We have to see that what are the allowed expenses that may be wholly and exclusively for business purpose. These are the allowed expenses. Maybe as accounting profit we deducted or not deducted, we will see in the detail, and accordingly we'll make the adjustment. But here the most important, not capital in nature, asset amortization and depreciation allowed. Here we already seen according to the tax period, not personal, allowed as per the ministerial decision. So allowed expenses, we will go through the Article 28 later on, because now we'll continue on the add back or the add back and disallowed or allowed expenses. Now, as of now, we wish to continue this part, then we'll come back on this also. So here we have the list of disallowed expenses written in the Article 33. Now, would you please go on Google and search the city law Article 33. If you go and search the Article 33, there's a list of items will be appearing. So that we're gonna discuss. Due to because time is not our time is limited window, so you can go and check. If you have any query, you can share with me. I'll reply on that. But we are gonna discuss the same way for our understanding. But later on, we may go through the article relevant article also. Let's start from here. Listed below item. Now we are discussing the 12 item. This is one of the item, that is the list of disallowed. What is saying? Disallowed. The first adjustment, under the first adjustment, there is a 12 disallowed item. So that we're gonna discuss over here. Grants, donation, gift to the non-qualifying public entities as per cabinet decision. In the VAT we already seen, or in the first session or second section, we already seen the public qualifying benefit entities as per the cabinet decision. So the ministry FTA already shared the public qualifying entities list. If the entity are falling in that list, is appearing in that list, then you can deduct that expense. If it's not falling under that, that is a disallowed. Why we do that? Because to avoid the anti-tax abuse, GAR rule they made to avoid the people look the way being because people might not interested to pay the full taxation. They are routing the transaction from the such charities or donation related organization. They might set up such organization, small organization, and facilitate the avoiding the taxation. So to monitor that, to manage that, to control that, FTA during the VAT stage, they already announced the qualifying public benefit entity in terms of the donation grants. So there is a list of the approved entity. If you pay to them, then it will be 100% deductible. If you're not paying to them, you are paying any other non-listed and charitable organization, that you cannot deduct. That you cannot deduct. If you already deduct, if your profit is 1 million, you have to add back the whatever the amount that you paid, maybe the 200K you paid to the charity organization. Now you have to add back into 1 million, and your taxable profit will be 1.2 million. Let's move to this is our first point. Now we are gonna see the next part, that is the interest capping rule. Interest limitation rule, ILR. So interest capping rule, earlier we seen in the overview, but now we're gonna discuss in detail what are the interest capping rule. So normally the interest capping rule the law is saying the 30% of the adjusted EBITDA, earning before interest and tax. The word adjusted, there will be a couple of adjustment is might required to be done, but based on the each entity or each entity operation, if applicable or not applicable. But we will go through that part as the exercise. So we are saying what is the rule? 30% of the adjusted EBITDA are the 12 million. As a safe harbor, the FTA and they announced the 12 million. If you have the net interest is at 12 million or less than 12 million, you don't have to do the calculation. All the amount will be deductible. But if you are exceeding the 12 million, let's say you have the 20 million net interest, then you have to apply the formula and go through the calculation and then see what are the deductible expenses. Because now you're exceeding the 12 million. Now you have to calculate 30% of the taxable income of the EBITDA, and whichever is higher. Maybe your 30% is coming 15 million, but minimum harbor is a 12 million. Now is a higher of your interest capping limit will be 15 million, not 12 million. So here we have the article 29 and 31. Wherever we mention the article that we referring to the city law, article 29 and 31. We will go through this article also, but let's understand the overall this concept and the overall this application of this regulation. So this is the point what we are discussing from the city law and how what are the regulation over here. We are saying the maximum net interest expense. Net interest expense, this definition need to understand. Net interest, maybe you have some interest income and some expenses. So first you have to plus and minus both together. Whatever the amount is coming, that is a net interest expense. So this rules will be applied based on that. So here the net, and here we also anti-avoidance tax legislation. The BEPS, as per the OECD guideline, the BEPS is the base region profit shifting. So the OECD, they made this BEPS maybe in a 60, 70 year before, and they are keep refining in latest version, either 2015 is available, the BEPS origin profit shifting. What is that? First, we have to understand the basic concept of that. Why the BEPS applied this? Because the taxation in the UAE is coming from the as per the OECD guideline. But this is not the 100%, but they follow the OECD guideline. But as per the taxation, the main content or the main framework they taken from the Netherlands. From Netherlands, they taken, plus they follow the OECD guideline and some other adjustment they made on that. So base origin profit shifting. What is that? Just for our understanding, we will do some exercise also in the same topic. If the one investor or one owner, they have company in the UK, in the Europe, any other country of the Europe, and in the UAE, or they have any other company or branch in the other part of the world, maybe the Africa or maybe any other where the taxation are not the higher. So in the UK and Europe, the taxation is reaching up to 19%. If we go in the corporate tax, or maybe certain area, it will go up to 30% also. But let's say even in the 19% the corporate tax in the UK. So what they will do? To avoid the tax, they will increase the tax, they will reduce the tax base. How we will reduce the tax base? This is, I'm not suggesting to do the such things, but I'm giving you the understanding. What are the basic understanding why the OECD, they developed the base origin BEPS, this model. To understand that concept, I'm giving the example. If they have one company in UK, they're paying 19% corporate tax, and one company in UAE, they are paying 9% corporate tax. Another company in the another part of the world, let's say in Africa, will not mention the name, where the taxation is the 5%. Now we have the three different taxation. One is the 5%, another is the 9%, and another is the 19%. So which one is the beneficial for them? Because if they avoid the tax, they pay 5% is the much benefit, because now in that case they are securing the 14% of the taxation. Versus if they come in UAE and they say the 9%, still they are saving the 10%. So now they will do their calculation and they go through the legislation and they will see what are the possibilities where they cannot, within the legislation, what are the allowed things that they can to manage to optimize their tax liability. So let's say they want to reduce the profit in the UK. So what they will do, they will increase their expenses. While doing this, we will say, okay, they are reducing the tax base, which means they are increasing the expenses. How they will increasing the expenses? They will do the transaction in a way because they will take the loan from the UE company and they will pay the interest expense to the UE company. Once they pay the interest expense, their interest will be their tax base will be reduced. Why? Their profit will be reduced because as a interest, they are shifting their profit to the UE. And here the profit is the 9%. So eventually they might save the 10%. To avoid this such things, they put some cap. They said, okay, interest cap rule to avoid such profit shifting, they introduced the BEPS. So this is the one of the interest capping rule as per the BEPS model. So here, what is the law in UE? We have to, while doing the calculation of the interest, how much is the allowed and how much is the disallowed. Here we are saying the allowed means that in the accounting profit you can adjust and disallowed you cannot adjust to calculate the corporate tax. As per accounting, maybe you are deducting the 100%, but in the taxation point of view, you have to make the adjustment. So they think higher of. What is the higher of? 30% of the EBITDA. EBITDA is the adjusted EBITDA. And 12 million is a safe harbor. So this concept, safe harbor, if your interest, net interest is a 12 million or less than that, then you don't have to do all this calculation. But if it's exceeding 12 million, then you have to do the calculation. You have to calculate the adjusted EBITDA, then take the 30%, and that the higher one, that will be your limit. Up to that limit, you can deduct your expense and rest all will be added back to your accounting profit. Here we are already seeing the taken from the BEPS OECD action plan. Now the second part, if they are discouraging the interest, so what they are doing, they are encouraging the equity. People, instead of taking the loan and putting into their business, they are saying invest your own funds, invest your own money into the business. So they encourage, they want to, another point, another perspective, we might understand they are encouraging the investor to bring the funds in the UE and invest in the UE business. So here we are discussing the net interest. What is the net interest? Just here I prepared this net interest expense, interest income plus minus both. Then it will be appear the net interest. So then on the net interest, we will apply this rule.